Good morning, everyone. Welcome to Windsor Brokers live daily market outlook. Today is Monday, 7th of January 2013. The US dollar remains well supported against the major of currencies as euro stays under pressure following bounce from last Friday's low of 129.96, where basically the pair tested the psychological 130 support. But so far, corrective action was short-lived and being capped under psychological 131.00 resistance, also being capped by descending 55 days exponential moving average that keeps the pressure on the downside, with the market price action on the European opening coming again under pressure and losing overnight lows at approximately 130.30 levels. And now again turning focus again towards 130.00, below which would be signal for some stronger extension following the pair's recent multiple attempt at 133.00 barrier that proved to be quite a strong resistance, and the subsequent reversal through important 131.57 and 131.00 supports, seeing more focus towards the downside. Dollar yen also remains in the corrective mode after hitting fresh highs at 88.40 was the last Friday's high. Basically, these are the levels seen last time in July 2012, with the profit taking seen as the main driver of the pair's recent pullback. But overall, the picture is still quite bullish as the pair cracked psychological 88 resistance, and the weekly close above this level, slightly above 88.10, I think was the last Friday's close, still sees more room for further extension higher. Most of analysts agree, despite technicals being quite overextended on lower and the higher, larger time frames. More room is seen for further extension towards the upside as new government in Japan sees potential for further action, and that expectations basically of more monetary easing by Bank of Japan after the new Japanese government expands its economic policies, and the yen is likely to stay under pressure from Japan's trade deficit and yen selling related to Japanese firms' acquisitions of overseas businesses. The dollar Swiss is under it's well supported in the near-term price action as pair tested last Friday 93 barrier, and the subsequent pullback being contained at 92.30 with the 55 days moving average, seeing again in the near term more potential towards the downside as hourly and 4-hour technicals remain supportive, while the sterling is correcting, consolidating, I would say, rather recent losses, heavy losses from 163.80 peak of last week, still holding above psychological 160 level, but not much to be expected on the upside as technicals remain firmly bearish on the lower time frames, and seeing again more potential for a possible break below 160 that will open way for a further reversal and basically will keep the upside protected. For now, the pair is on the larger picture still within the range of approximately 163.80 on the upside and 158.26 on the downside, as failure to clear 164.00 triggered a fresh sell-off that is now threatening the downside with the loss of 160 to open 159 zone, where is also the main bull trend line. From commodities, the crude oil holds its positive tone after hitting a fresh high at 93.83 last week, with the current pullback seen rather as corrective as the previous highs at 91.48 stay intact. Basically, the pair hit 91.52. It's approximately near the 200 days moving average, keeping the positive tone despite quite extended conditions on the hourly, on the 4-hour chart, while hourlies are still showing some positive tone. It's important if we stay above 91.50, that will keep the upside in focus. And of course, gold is still under pressure following stronger dollar, and the last Friday's dip to a fresh low at 16.25 sees more risk towards the downside and possible further stretch of the latest down leg from 1723. This is the high of 12th of December 2012. Quite poor calendar for today. We're going to take a quick look at it. From Eurozone, foreign currency reserves in Switzerland for December showed a slight decrease from previous 427.4 billion Swiss franc to 427.2 billion. While Sentix investors' confidence for January in Eurozone is due at 9:30 GMT. Some improvement is seen, although still negative figures. Minus 16.8 is the release of the month of December 2012, while January's forecast is slightly more positive, minus 13.8. Eurozone producer price index for November is due at 10 o'clock GMT. Monthly release shows, according to the forecast, no change from the previous month release at 0.1%. Canadian IVPMI for December is due at 1500 GMT. We have forecast is 51.3 for some reason. We don't have it in our calendar. Improvement from 47.5 release of month of November. That will be basically all for today's releases. Quite poor calendar as we are at the beginning of the week, but technicals are quite interesting, and I wouldn't waste more time. And let's see, and let's take a look at the technicals for major currencies and commodities to see the forecasts and expectations for today. As we said, the euro remains under pressure following, as we can show on the 4-hour chart, multiple attempts at 133.00 and the rejection that triggered this fresh reversal. The pair stayed for approximately 1.5 weeks in the consolidative mode above, below 133.00, being supported at 131.60 zone, but last week's break below, last Thursday's break below this level, that it's also close to 38.2% retracement of the upleg from 128.76 to 133.07 has triggered fresh weakness that so far retraced nearly 76.4% on a dip to 129.96, cracking a psychological 130 barrier. The upside remains capped. The bounce from 130.00, where temporary floor was found, remained capped at 130.88. This is the high of last Friday. It's also the descending hourly 55 days exponential moving average, and the fresh weakness, it seems to be traveling again towards 130.00, our initial support, and last Friday's low, as the pair seems to be unable to regain strength and momentum for some more serious corrective action, with 131.11, where is 38.2% retracement, still staying intact. And basically, as long as we hold below these levels, more focus is in towards the downside. To support the notion, the hourly studies are negative, as we can see. MACD and the momentum are below their midlines. RSI is pointing lower. The price is holding below all three moving averages, with the 10 days crossing below the 20 days exponential moving average on the hourly chart, keeping the pressure towards the downside, and for test of initial 130.00 level. That may open way for a fresh extension lower. And then we have the double Fibonacci support at 129.80 zone. It's initially 76.4% of 128.76 to 130.07, and the 50% retracement of the larger rally from 126.60 to 130.07. As we can see on the daily chart, the pair is losing its initial bullish momentum, as the 14 days momentum now breaks in the negative territory. RSI is pointing lower, MACD is pointing lower. Immediate risk is seen down at 130.00 and 129.80. That is also reinforced by now sideways moving a 55 days moving average. That may open way for test of the trend line support, currently standing at 129.35. This is the larger trend line support of the larger rally from 120.42 low of 22nd of July 2012. This is basically 2012's low. That the trend line is standing at 129. We set 129.35 approximately, and more focus again seen towards the downside following the negative tone on the lower and the larger time frames. with the bears shown on the ADX studies also now gaining pace again, with the Ichimoku studies now turning negative, though the price broke below the Tenkan Sen and Kijun Sen lines. Still the cloud top support is currently at 129.00, but having initial negative signals for further reversal towards further reversal of the rally from 126.60 to 130.07. Further retracement of this rally with the break below psychological and last Friday's low at 130.00, expected to open way for a further weakness. British pound also remains and starts the week at the back foot, but still holding above 160.00 last 160.00 previous lows and last Friday's low, basically at 160.08. But corrective action so far, showing not much of the action towards the upside. The 160.81 was the highest level seen overnight, followed by fresh easing down to 160.20, again approaching last Friday's low, with the negative tone still dominating on the hourly chart, as most of indicators are in the negative territory, though the reversal on stochastic might see some price action again higher. We have initial 10 days moving average at 160.43. That is currently under pressure. 160.50 is the 20 days one, and the more significant is overnight's low at overnight's high at 160.81, and the 161 zone where we have a 23.6% retracement and descending 55 days exponential moving average. And basically this is the initial barrier, break of which is set to allow for some stronger corrective action. Otherwise, a negative tone that dominates on the 4-hour chart still sees the 160 at focus and under increased risk, as the bearish crossover of 20 over 55 days moving average sees now more potential towards the downside, with the most of indicators holding a negative tone, as a break below 160.00 as strong support sees potential for extension down towards 159.60. This is the low of 28th of November 2012, and also marks 76.4% Fibonacci retracement of the upleg from 158.26 to 163.80. So basically the near-term structure remains under pressure. Let's just have a quick look at the Ichimoku studies. Again, negative tone is dominating as the price enters the cloud. The cloud breaks the cloud top at 160.67, with the Tenkan Sen now approaching the Kijun Sen, and possible crossover is to give us another bearish signal for the pair. Only break above initial 161.00, and I would say more significant 161.50, 162 that marks 38, and the 50% retracement would probably revive bulls and shift focus more towards the upside. Until then, more focus is again seen towards 160.00 and 159.60. Our next downside target seen on a break below 160.00. The dollar yen is taking a break following again a strong rally and extension of the last week that posted fresh high on Friday at 88.40, cracking and closing above 88.00 as psychological resistance sees more potential towards the upside, although corrective action currently underway, triggered purely by technicals and profit taking. As we can see, the hourly indicators are now pointing lower and approaching, basically they're breaking into the negative territory following pullback of 88.40, with the lowest level seen last Friday at 87.58, now coming under pressure 87.61. Since so far as the pair cracks the 55 days, hourly 55 days exponential moving average, while the bearish crossover 10 over 20 days moving averages sees more potential for further extension. Lower good supports are at 87.35, that marks the last Thursday's high, and the 38.2% retracement of the upleg from 85.64 to 88.40. And the next one is 50% retracement and round figure support at 87.02, above which we see it as ideal. This zone above 87 is seen as ideal reversal point for extension of the larger uptrend towards 89 and 89.50. Our next upside targets. Currently we're still in the corrective mode, and ideally reversal above 87 approximately at 87.35. That is quite good support. Would be seen preceding a fresh extension higher, where we have 89.00 and 89.14 is the high of July 2012, and then 89, pardon, July 2012, and then 90.00 is around figure resistance would come in the near-term focus. And from the currencies, dollar Swiss is the last one. Corrective action of last Friday's fresh high at 93.02 was contained at 92.29 by ascending a 55 days exponential moving average, with the hourly structure now gaining traction and gaining momentum following bounce of 92.29. This is last Friday's low, with the indicators now pointing higher and the price breaking above 10 and 20 days exponential moving averages, keeping the near-term focus at the upside, and then 93.00. This is psychological resistance, and the break above. This is also close to 76.4% retracement of the latest downleg from 93.81 to 90.80 zone, where the double bottom has been formed, and the price action is now heading towards 93.00, break of which is to open another significant barriers at 93.80, previous highs of 7th of December 2012, and 94.00 is around the figure resistance. Hourly structure is, as we said, positive. 4-hour indicators are holding in the positive territory, and seeing more focus towards the upside, while the daily structure is now improving. Fresh momentum is seen on the daily chart, with the price action so far being limited also by descending main bear trend line drawn of 2012 peak at 99.70. That currently stands at 92.99, and break above this level is to open way for some more significant corrective action. As the larger picture shows, the pair is still in the strong downtrend of 99.70, with good base now being built at 90.80, seeing scope and potential for a stronger recovery. We need to see the break above 93.00 as initial barrier to open way towards more significant 93.80, 94.00, and then we have the previous double top at 94.30, reinforced by 200 days moving average currently at 94.26. On the downside, immediate supports, mild support 92.50, and then approximately 92.50 zone, and then 92.29. This is the low of last Friday, with the Fibonacci supports standing at 92.16. That is 92.49 is 23.6% retracement, and 92.16, 38.2% retracement of the rally from 90.77 to 93.02, and ideally any dips should be contained above 92.00, ideally at 92.29, as we have seen already good support here. But in case of any reversal, dips should not go below 92.16, 92.00. Otherwise, that will be a signal for a pause in the current bullish action, and a signal for some further weakness that might risk again test of 91 zone as our initial strong support. On the upside, as we said, clearance of 93.00 is to open 93.80, 94.00, our next upside targets. And the crude oil, as we said at the beginning, is well supported, for now emerged off the daily Ichimoku cloud that sees potential for sees a bullish signal for further extension higher, as the Tenkan Sen line is now also coming out of the cloud. That again suggests that further corrective action of the larger 172 to 84.05 rally is seen quite likely in the near term. Hourly structure is pointing lower. The studies are pointing lower following last week's high at 93.83. Still in the corrective consolidative, I would say rather consolidative action, as the price action being held above previous high at 91.48, and also the 200 days moving average currently at 91.44, seen as ideal support to hold any stronger dips for fresh extension higher above 93.83. We have 94 as around figure resistance, and the 61.8% retracement of 172 to 84.05. Down leg at 94.35. These are the strong resistances. 93. 94.00 and 94.35 seen basically as the next upside targets. Only loss of 91.50 would delay immediate bulls and allow for some stronger corrective action. This is also reinforced on the 4-hour chart by ascending a 55 days moving average, currently standing at 91.34. So basically we have quite a strong support at approximately 91.50 zone, and holding above this level keeps the immediate focus at the upside for 93 for test of 94.00 and then 94.35 Fibonacci support. Otherwise loss of 91.50 would risk a test of 91.00 and a possible stretch down towards 90.00 zone, double bottom and the corrective consolidative action floor of the last week of December at 90.00. And finally, the yellow metal remains under pressure. Now it's going to be good if we find it. Remains under pressure as we can see the bears are again taking control on the daily chart. With hourly structure showing some corrective action of last Friday's fresh low at 16.25 with the 16.62 seen so far. This marks a retrace approximately above 50% retracement of the initial down leg from 16.94. This is the peak of 2nd of January down to 16.25 last Friday's low. Slight improvement seen on the hourly chart, but so far the price action holds below 55 days exponential moving average and sees more risk towards the downside as long as these levels stay intact. On the 4-hour chart, the indicators are still holding firmly in the negative territory and seeing more risk towards the downside as a bearish crossover of 20 over 55 days exponential moving averages at 1670 and the price action being current corrective action being capped by descending 20 days exponential moving averages, still keeping more focus towards the downside. Break below initial support at approximately 1650 is to open 1635, the previous low of 20th of December, and then our main support at 1625 last Friday's low. That will be signal for a fresh extension lower, and basically the pair tested our initial target at 1628. This is Fibonacci 100% expansion of the wave from 1752, and basically we are looking for a test of also the 200 days moving average so far limits the upside action at 1660. We see the more focus towards the downside as our daily studies maintain negative tone, and the break below 1625 last Friday's low would look for test of static supports at 1600, 1590, and then we have 1580, which marks 138.2% Fibonacci expansion of the wave from 1752. And that's all for today from my side. You can submit your written questions now. If there is any question for today at the beginning of the week, I'll be glad to answer. We have a question for Euro Yen. Let me just open the chart and then we'll take a look. Okay, it looks quite supported, and a strong rally that cleared the previous high and the resistance at 111.42. This is the high of 2012, extended so far to nearly 116, cracking the weekly 200 days moving average, with the daily structure being quite extended, and we are facing here a congestion. I would say the consolidation of the latest rallies that peaked last week at 115.97, but the downside so far being contained at approximately 113.60, and by ascending 55 days exponential moving average. However, descending 4-hour indicators and the loss of initial momentum might see some stronger corrective action, which is not ruled out at this point, and break below 113.60 as our initial support. That also marks 23.6% retracement of the uplift from 105.96 to 115.97. Would see possible extension lower down towards 112.46. That is a high of 19th of December, and then 112.15, 38.2% retracement of the rally from 105.96 to 115.97, and I would say at this point this is seen as ideal reversal point in case of break below initial support, so 113.60 and 113 zone. As daily structure, as I said, is quite extended technicals, but overall positive tone seen on euro against Japanese yen, as yen is weakening significantly against US dollar. Also sees again more potential towards the downside, towards the upside, pardon, but quite extended technicals on the daily chart see risk of some possible corrective, stronger corrective action. Hourly, pardon. Our structure is more aligned towards the downside, following a bounce that was capped overnight at 115.54, and fresh slide now looks for test of sees more focus again towards 113.64, 113 zone, while break above 115.54 overnight's high will would signal return, possible return down up to 115.97. For our is still holding positive tone, though descending indicators again see risk of testing 113.64, reinforced by 55 days exponential moving average. I would say the holding above this level will keep the upside, immediate upside in focus. Otherwise, we might face some stronger corrective action with the good supports, as we said, 113.16, 113.00 is around figure, and the 112.50 approximately previous highs, and the 112.15, 38.2%. Any break below 112 would be a signal for some stronger correction. Any further questions, please? No more for today. Good, then thanks for being with us. We are back in fully now after I was a bit away for a couple of days. We are continuing our regular daily sessions. Every day we're on at 8 o'clock GMT. If you face any difficulties and technical problems, as we had some, I can see that has been resolved, please don't hesitate to contact either me on analysis@windsorbrokersltd.com or our marketing department that is in charge for any technical preparations. We expect to see you again tomorrow morning at 8 o'clock GMT. Until then, I wish you a nice Monday and nice beginning of the week. Good luck.